On Friday morning, one government report could either back up the Federal Reserve's decision to sit still or hand fresh ammunition to the three officials who just voted against their own chair. This is why the July jobs report isn't just another data point this month. Here's what's actually at stake and how to read it when it lands. Welcome back to Market Insights, the weekly breakdown from quicktrade.world. Quick disclosure before we start, I'm an AI-generated presenter, and every figure in this video is pulled directly from verified reporting, not estimated. Where a number appears on screen, you'll see exactly which outlet it came from. This week, instead of breaking down a story that already happened, we're setting up a story that's about to happen. Friday's non-farm payrolls report for July. To understand why this particular release matters more than a routine monthly number, you need two pieces of context: what the last jobs report actually showed, and what the Federal Reserve did 3 weeks after seeing it. Let's build both. As always, nothing here is a recommendation to buy, sell, or hold anything. This is market education, not personal financial advice. On the 2nd of July, the Bureau of Labor Statistics reported that the U.S. economy added just 57,000 jobs in June. Economists surveyed by Bloomberg had forecast 113,000, so the actual number came in less than half of what was expected. The unemployment rate actually ticked down to 4.2%, its lowest in a year, but that wasn't the good news it sounds like. It happened because the labor force participation rate fell to 61.5%, the lowest since March 2021. In plain terms, fewer people were working or actively looking for work. So, the unemployment rate, which only counts people actively job hunting, went down for the wrong reason. On top of that, the 2 prior months got revised lower by a combined 74,000 jobs. May's initially reported 172,000 gain was cut down to 129,000. Leisure and hospitality, which had driven May's strength, actually lost 61,000 jobs in June. The gains that did happen came from professional and business services and private education and health services. Put together, June was a genuinely weak report dressed up by a misleading headline, unemployment number. That's the backdrop the Fed was looking at 3 weeks later. On the 29th of July, the Federal Open Market Committee met to decide on interest rates under Fed Chair Kevin Warsh, who took over the role on the 22nd of May. The committee voted 9-3 to hold the benchmark rate steady in a range of 3.50% to 3.75%. Here's the part that made this meeting genuinely unusual. 3 regional Fed presidents, Dallas's Lori Logan, Cleveland's Beth Hammack, and Minneapolis's Neil Kashkari, dissented in favor of raising rates by a quarter point instead. That's 3 officials voting against holding steady, all wanting to go the same direction. According to reporting, that's the first time since September 2016 that 3 policymakers dissented with a unified view on which way rates should move. Chair Warsh's own words summed up the mood. "I asked for a good family fight, and I got one. That's the purpose. That's the design feature." He's also been clear elsewhere that he sees inflation as, in his words, a choice, a philosophy he's repeated since his Senate confirmation testimony, signaling he takes the hawkish concerns seriously even while choosing to hold for now. So, heading into Friday, you have a Fed that just held rates despite a weak June jobs report, 3 senior officials on record wanting to hike, and a chair whose own credibility is being watched closely for whether that patience was justified. So, what are economists actually forecasting for July? Capital Economics is looking for a gain of around 130,000 jobs. Continuum Economics expects roughly 120,000 overall, with about 110,000 of that in the private sector, largely on an expected recovery in leisure and hospitality hiring after June's seasonal dip. Notice what that forecast actually implies. Economists are expecting a meaningful rebound from June, not a continuation of the weakness. If they're right, it would support the idea that June was more of a seasonal blip than the start of a real slowdown, which would tend to support the Fed's decision to hold rather than panic cut. If they're wrong, and July comes in soft again, that starts to look like a genuine trend rather than a one-off. And trends are what move Fed policy. Here's a simple framework for watching Friday's release, instead of just reacting to whatever headline your notifications show you. First scenario: a soft print well below the roughly 120,000 to 130,000 consensus, something closer to June's 57,000. That would be the second weak report in a row, and it would put real pressure on the Fed's hold stance. It would raise a real question about whether Logan, Hammack, and Kashkari were reading the labor market correctly when they pushed for a hike, because a second soft print in a row would suggest the market is already cooling faster than the Fed's given it credit for. Second scenario: a hot print, meaningfully above consensus, say 150,000 or higher. That would support the three dissenters' case that the labor market has plenty of room to run and would make the argument for a near-term rate cut much harder to justify. It's also the scenario markets often read as good for the economy, but potentially less friendly for near-term rate cut hopes. Third scenario: a print that lands right around the 100,000 to 140,000 consensus range. This is the messiest outcome for headlines, but arguably the most realistic one, and it wouldn't resolve the Fed's internal debate either way. That's normal. Not every data release has to produce a clean verdict, and treating a single month's number as decisive is one of the more common mistakes retail investors make around economic releases. Whichever way it breaks, remember June was also revised twice after its initial release. Friday's first print is a first draft, not a final answer. Here's the actual lesson this week, beyond just the jobs number itself. The same payroll figure means something different depending on the environment it lands in. A 90,000 print in a calm policy environment might barely move markets. That same 90,000 print landing 3 weeks after a Fed chair publicly acknowledged internal division, with 3 officials on record wanting to hike, carries far more weight. Because it's not just an economic data point anymore, it's a data point in an active argument about what the Fed does next. That's why context setting, understanding what happened last time, and what the policymakers who react to this data are currently disagreeing about, is just as important as the headline number itself. If you only ever look at the number in isolation, you'll consistently misjudge how much the market is going to move on it. That's the setup for Friday. Once the actual number lands, we'll be back with a fast turnaround breakdown of what it actually showed and how markets reacted. This one won't wait for next week's regular slot because reaction content like this loses its value fast. If breakdowns like this help you trade with more confidence, register now on platform.quicktrade.world and gain access to the world of trading. Subscribe so you don't miss that follow-up, drop a comment with which of the 3 scenarios you think is most likely, and we'll see you right after Friday's print. This is quicktrade.world.